Good morning, ladies and gentlemen. And yes, we are now in full risk on all three time frames, the daily, the weekly, and the monthly. The weekly triggered at the close on Friday, so we are completely in risk on. The risk dial keeps on rising. Anything above 30 or so is quite bullish, and I'm sure we'll get it even more bullish in the days ahead, regardless of what the market does, because the spreads have started moving in the right direction. So if you have a look in the data column, you will see that on Friday, on the 12th, we went into risk on as had been advised. Absolutely not a lot to add to that. We are in risk on, but we still have to be careful of short-term variations, as I'm going to show you in a second. The allocation model in the allocation model tab that I use for confirmation is also in SPY and has been since the beginning of the month. So really every single indicator that I follow is saying this is the beginning of a strong trend, and that is what the spreads are showing. However, yes, and there's always a however, isn't there? You can see how close we are to the red line. Yes, it started expanding, but I expect it to do something like this. So we are going to have a very slow grind, punctuated by some pretty steep falls to basically stop people out. You can see what the level of the two standard deviation line is, 301.78. So that puts the futures somewhere around 25 to 30, 3025, 3030, maybe 3035. Hardly a million miles away from where we closed on Friday. As you can see, when we look at the other sectors, really what is going to get us up there and what is going to make us go even higher? We have, the energy sector is very close to its upper range. We have an important sector, the telecom, which is through it. So I would really not be long of telecoms, because telecoms are very interest rate sensitive, and I think this will retrace, if anything. Then we have the utilities, and utilities are basically mirroring the bonds, so they're more likely to come down than go strongly up, and it's such a small sector anyway. Yes, materials have some room, but not really a lot, right? And also a very small sector. We have technology very close to its red lines, basically less than 0.5%, and then we have the financials, which have touched it on Friday. So I hedged all my financials positions, and healthcare is unlikely to boost us very much, simply because it is in a politically dangerous time as the US elections approach. And then we have the staples, which are XLP, which I don't think really can carry us much further, simply because they are bond and interest rate sensitive. And then we have XLY, which is actually very overbought, so, and more likely to come off slightly than not over the course of the week. So what we are saying is that yes, we are in risk on, and that is a long-term parameter, and risk on actually means that equities are likely to outperform bonds. It doesn't mean that they're going to go up in a straight line, and I really wouldn't worry about chasing the market at any stage soon. The Blue Angels basically say it all. Every time the market has exceeded the 17 times Blue Angel, it has come back to it. So really, I would not worry about chasing this market. You will see it cheaper and more expensive. It's a tactical market. It's a summer trading market. I would have thought that the technicals are going to be very important indeed, and I will show those in a moment. We start our review of the bond markets with a 2-year. I think we nailed the range last week, 180 to 192. I think that range will actually persist this following week. And that is why I also think that markets are going to move very little over the course of the next week. There is very little impulsion or reason for the 2-year to go much higher. I still expect at some stage a scare before the Fed comes in, which takes it above 2 to about 205, but I think that is going to be a wonderful investing opportunity. Anything higher than 192 all the way up to 205 is a wonderful opportunity to reload heavily on the 2-year. One of my favorite charts, the difference in yield between the 10 years in the States and in Germany, confirms that this 245 level is extremely important. You can see how well it held it. I managed to buy some, not a lot, small position just to get a taste in. I now would want this market to start going towards the 200 level. That is my favorite direction, but if it breaks below 245, it'll be a failed break, and I think we could have a move all the way to at least 258, 260, and that is going to have larger repercussions on the dollar. The 5-year also, we got the range spot on. Really next week, the maximum I expect is to this kind of level. 193, 194, maybe 197 maximum. That is what I'm looking for. On the downside, I think it's going to be very tough to push it through 180. So really, a 12 basis point range, it's going to be quite summer trading, very technical, not a lot to really get you very excited. I don't think the 10-year is going to do much either. At some stage, I would love to see it at 220 to basically put some more position on, looking for yields below 190. Very tough to see it breaking this line next week, and that's 204. And so 204 to 215 to 220 really holds it all of next week. The next 2 weeks, I think, very much the same kind of story. We're going to be holding in and just stopping people out both ways before the Fed announcement. The TLT did exactly what we thought. The break of 132.08 is leading it down towards the 127.5, 127.30 level. And this is the reason why I think that interest rates are slightly more likely to go up than down next week. I think it's almost a given that over the course of the next 2 or 3 weeks we're going to see this 127.37 level that is so pivotal. I expect it over the course of the next couple of weeks, and that is probably a very good level to buy some calls in TLT. Well, whatever time frame you look at, really the equity markets are doing very, very little wrong, if anything. While they are bounded by this mauve moving average and the top of the Bollinger Bands, I really don't think there is very much to think about. We're talking about 3,025 and 2,980, 75. That is your range really for the next week. I'm a better buyer of dips should we break this mauve line down towards 29.50. I really don't think we break the red line, but that is as may be. I do think that 3,025 is going to be very, very hard to break on the upside with any sustainability. So basically, my advice remains the same. Move out of outrights, swap them into calls. With volatility this cheap, it is silly not to. As I said, whichever time frame you look at, and this is the weekly, you get the same picture. You get the Bollinger Bands up top. If you look at the monthly, again, we can try and enlarge it. You still get the the Bollinger lines right up here. So it's so difficult to buy above them simply because you know that the market will retrace and will probably retrace all the way to this red line. It's never not done so. So, 2,840, by that time it'll be 2,864, which was that very, very important level, right? So that is what the market is saying. It's going to get everybody long, probably above the Bollinger Bands, spit them out, and then go. To me, we're still in risk on simply because I see very little possibility that the market is going to go for higher yields. The Fed has probably nailed its colors to the mast now. It's going to be easing, but really the bonds are going to be the least beneficiary from that, simply because you're going to get a steeper yield curve, and that actually is very good for XLF. And not so good for other sectors. I wanted to show you the Russell as well on the weekly because I think this was a very important week. I tweeted that 152.94 was going to be critical and it had to be held at all costs, and it stopped right there. I mean, it just ticked it. And then came back 1.5% or so. I still think that this, if you want to be long, the call spreads in this are probably the ones that are going to give you most reward immediately. You can see how far away it is from the weekly Bollinger Bands. I think that we easily have 3% on the upside, while the S&Ps do 1%. And I've shown you also the spread chart between the Russell and the SPY. It definitely favors being long of Russell at the moment rather than SPY. We are at an extreme that we haven't seen exceeded in the last 10 years. And therefore, really, Russell is my preferred long option here. I have really very little to say about NQ, apart from the fact that it's trading so much on a par with SPY, while its volatility of returns is so much higher, that I don't see the point of trading NQ at all. Mathematically, it makes no sense. When it starts leading, yes, I certainly would be more interested, but it is in technically much the same picture as SPY. We have the top Bollinger Bands tight against in all periods, whether you look at the weeklies, the monthlies. It really is, even if you look at the 60-minute charts, it's very difficult to get excited and trade NQ as opposed to trade SPY. If the risk reward is the same with the risk profile that NQ has, just makes no sense. Another excellent reason not to get overexcited by what SPY is doing comes from the DAX. The DAX basically gave up each and every day last week, and rather than moving with SPY, it moved against it. Now, that is an obvious warning sign. I would have thought the DAX now comes back towards 12,100, where it's probably a very good buy for a move back up to 12,500 and the fill of those gaps. So there you have it. I think there's another confirmation from the European market. Don't get excited, overexcited on with longs on the upside. When the market comes off in the States, if it ever does, you buy some calls as opposed to outrights. You swap your current outrights for calls because volatility is so cheap. Those are the messages from all the markets. Volatility is basically very, very cheap. This is a daily chart. There is probably a reason for it, but you can see how July last year we're exactly the same levels, repeating the same pattern. Uh, this is telling me that the market is actually going to go nowhere in a hurry, but really every time it drops towards 11, you have to be long of it. I know it's very difficult to hold, but this upward sloping 200-day moving average tells me that at some stage we have spikes that you can sell somewhere around the 16 area. So really it pays to be long of volatility at 11. If we look at a weekly chart, much the same kind of picture. Anything that you can pick up 11-ish, you are more likely than not to be able to sell around the 16 area. Well, what to say about the dollar apart from it's difficult? It's not so difficult to pick up the range bottoms and the odds of where it's likely to turn for a bit, but all it does is very small moves on the upside. I'm really getting worried about my long calls position in Euro USD, because really the volatility is not what I expected it to be. I thought that the break of that 245 level in the 10 years would accelerate it, and really it's not doing so. Really it's critical for us to go above the 200 and then above 114.85. Until we exceed 114.85 on at least a daily, but preferably a weekly close, I will not feel comfortable that I am right that the dollar is going to turn and go lower and the euro higher and the Dixie down. So let's have a quick look at the Dixie. It is not very different from Euro USD. We are right on top of the 200-day moving average, but it seems to me that this 200-day moving average is becoming less and less important, simply because we are now breaking it too many times, both through the upside and the downside. It is flattening, so it's saying with time it's breaking down in importance. 95.07 still looks like it's going to be very tough to break on the downside, doesn't it? So really it's saying that this market is not going to really fly one way or another for some time. I think the market is now discounting the Fed easing and the ECB easing, and that really the moves from it are not going to be all that important. Really, maybe selling some volatility at the moment in FX might not be such a bad idea for the next couple of weeks, just to hedge some positions. Gold longer term is actually beginning to impress me. I would have thought that with the yield back up in bonds and also with the moves in the dollar, gold would have backed up more and would have been at least to this 1,370 level that I consider important. It hasn't done so. It keeps on, it's not powering ahead, but it keeps on being supported and bid at better levels than support. That is the beginnings of a bull market, I think. Another reason why I want to persevere with short dollar positions, maybe being long gold is a better proxy for my opinion than being short the dollar. I don't know. But it's certainly beginning to be a very nice chart. That's going to take some more time to turn and break. But really, and I'm still hoping against hope to see 1,370. It's a very good level to buy calls. So my biases for next week. Well, I've kept these levels in 2s, 5s and 10s and TLT almost unchanged. So you have the support and resistance. I am certainly a better buyer of futures if we get to these extremes like 205, 215 or 220. And if we get to ridiculous levels like 213 in the fives, to me that is going to be a very, very important level for the whole curve. SPX, really, please, please, please switch longs to options, to calls. The risk reward of being long here at this very moment, if you're trading, makes no sense whatsoever. The RUT is still my favorite to the upside because it held that 15, 52, 90 something level, and it has now excellent odds of outperformance because of its position in on the spread against SPY. VX, anything you buy sort of 11 to 12 area, you will at some stage be able to sell at 16. And this is what I said, we got to that level out. Yes, 4 to 20 is the pivot, bullish above, bearish below. I would have thought that now we get to 12,100 is a better long than short, and that is probably where I want to buy some European equities in the DAX. I've told you what I think about the Dixie. Nothing has really changed in the two most important levels to me. That's 111.08 or 114.85. Those are the breakout levels for Euro USD, and my very important levels in the Dixie. I still think that this is appropriate. I just think it's too easy to let people be long into the Fed. I think something's going to come out which is going to make people panic. The right long-term position, I think, is definitely risk on. I've looked at all the spreads and I'm really happy that risk on long-term is a good position from here. I'm just not so sure over the next 3 weeks. Thank you very much indeed, and tweet you on Monday.